The global economy just took a major hit, and it's not your usual trade dispute. Barclays just dropped a bombshell note, warning investors not to catch the falling knife. And what they mean by that is this. The sweeping new tariffs unveiled by the U.S. government are not just a bargaining chip. They're meant to last permanently. Let's break this down. On April 2nd, former President Trump made it crystal clear. These tariffs aren't going anywhere. The U.S. will apply them based on trade deficits, not whether a country uses non-tariff barriers. That means even countries that have traditionally enjoyed good relations with the U.S., like Singapore, are now facing a flat 10% tariff. This isn't just about China anymore. This is about restructuring the entire global trade framework. And just in case you thought countries willing to negotiate might be spared, think again. Vietnam, despite showing signs of cooperation, still got hit. Trump, notably, hasn't flinched even as markets tumble. And although some Republican senators have raised concerns, like those opposing tariffs on Canada, Barclays believes there's little chance of a reversal in the near term. This isn't just about politics. The economic implications are real and severe. Barclays now expects a recession-light scenario, not just in the U.S., but also in the Eurozone. Their forecast? U.S. GDP growth for 2025 revised down to negative 0.1%. Eurozone? Down to negative 0.3%. And the U.S. unemployment rate? Headed to 4.7%. So what's driving this? Mainly inflation. Barclays estimates that around 50 to 60% of the tariff-induced increase in import prices will pass directly to consumers. The rest? It eats into corporate profits and slows growth. That's a triple whammy. Higher prices, lower earnings, and slower expansion. Now you might ask, won't the Fed just cut rates to counter this? Not so fast. Even with the S&P 500 dropping sharply in recent weeks, Barclays believes the chances of a rate cut in May are slim. Why? Because inflation expectations among U.S. households are climbing fast. If upcoming surveys show expected inflation above 4.1%, it'll be hard for the Fed to ignore. Powell and the Fed are now trapped between slowing growth and rising inflation. That means less flexibility. And things could get even worse. If Europe retaliates, especially by targeting U.S. big tech, the earnings outlook for U.S. multinationals could deteriorate quickly. Barclays warns that if this retaliation escalates, the S&P 500 could drop all the way to 4,400 points. That's a sharp correction. So how should investors respond? Here's where Barclays is clear. Don't mistake a short-term bounce for a real recovery. They acknowledge there might be technical rallies after recent declines, but they recommend using those as opportunities to reduce exposure to risk assets. Their playbook? Shift toward a more defensive posture. Prioritize bonds over stocks. Stay cautious. This isn't the time to be a hero in the markets. With global trade rules being rewritten and policy tools increasingly constrained, this environment is less about timing the bottom and more about managing downside risk. So here's the bottom line. This trade war isn't just noise. It's not just temporary. And it's definitely not over. It's structural. It's global. And for now, it's here to stay.